Well, I say the key. So first of all, in venture capital is they're going to have their investment thesis. They're going to have time frames that you have to get something done in order for them to. They're usually operating on under what they call the 2 and 20%. Some of them are as high as 25%. And as I mentioned earlier, they're getting pressure now from their limited partners to invest because a lot of them, with the downturn in the market last year and valuations going down, people have waited the right time to invest. So what's happening now is all that money is committed because a family office commits to a private equity or venture capital, let's say $50 million, even if it's not pulled down, it's committed. So they could have a capital call at any one point in time. So the limited partners want them to invest the money because that's part of their overall plan. And if they don't do that, then that's not going to work. On the family office side, you don't need to do that. You should have your own criteria set up because you just can't say, well, we'll just wait and be patient. I mean, I think they should also have their own, business plan there. But the whole idea there is that it can be a more nurturing environment. And I believe that you can create a lot of longer term value. I know one family we talked to in Milwaukee, they had one company for over 17 years and they grew it from like $300 million to a couple $1 billion because they knew over time what they had and how they could actually build it. So, it really comes down to, and they had executives come and go, they told me, which was positive for everyone. It does allow for a much longer horizon in establishing the value. And also being, you could be taking a company that was doing, let's say, 5% of the business in their particular industry to something much greater than that because you're a survivor, you can add on, you have the culture. So it really can make a huge difference.